A grande honra de convidar o Dr. Surendra para a sua palestra. Dr. Surendra, por gentileza.
Thank you very much. I really appreciate that introduction. I don't know whether I deserve that much praise or not. But let me mention one thing. All of us know that light travels faster than sound. So many people look bright until the time they begin speaking. And this is particularly true of me because I'm speaking in English, and which is also bad English, a mixture of Indian, American, British, South African, Australian, all kind of English accents. And you are listening it from our fine translator who is rendering it in Portuguese. I hope we can communicate in this manner. Now, I'm going to make the presentation. The title of the presentation is Re-Emergence of Management Accounting. And on this slide, I've given you my email address. So anybody who wants to communicate with me after the conference, ask more questions which can be asked here, or discuss some points, or make some comments, please feel free to email to me. I read my emails several times a day whenever I have got an internet connection and a computer. Now, the way I will make the presentation, it is organized in several parts. I'll start with the beginning of the re-emergence of management accounting, and then I'll present to you a model of business management, because accountants are supposed to serve the management, particularly the management accountants, and the strategies which the managements have followed, particularly the balanced scorecard. And then I will go into the activity-based costing, which is one of the most important developments in the area of management accounting in the past couple of decades or so, and show that it can be used both for manufacturing and non-manufacturing activities. And also, I will go forward and show you that the information and analysis developed by ABC is and can be useful for making decisions and following various modern managerial strategies. And then I will mention some other developments which are currently taking place and the challenges which face the management accountants for tomorrow. Now, the management's functions are basically in the area of decision making. Management is supposed to make decisions. There are lots of other people in the organization which carry out those decisions, which implement these decisions. And the decisions are in the areas of planning, control, and the value-adding activities or the value chain of the organization. And I will go in some detail about these activities in relation to planning, control, and value-adding activities, because our further discussion on activity-based costing is related to activities. So we have to understand what are these activities and then see how the analysis carried out by accountants using ABC is useful or can be used in those areas. Now, in the case of planning, there is long-term planning and intermediate-term planning and short-term planning and day-to-day activities. Now, the most important strategic plan is relating to the structure of a company. And the structure indicates the nature of the business the company will carry out, its size, its location, the technology it will use, and things like that. That is the most important initial decision which the management or the people who have set up the organization have to make. And that leads to setting up an organization with the help of research and development and marketing forecasts and things like that. And the organization basically includes the design of the processes which the company will carry out and the design of the products which they will make. And once these decisions have been made, then the actual activities which add value to the company are started. And they also need a lot of support activities like human resources, data processing, accounting, administration, and so on. The other part is the control over these activities. And the control also again is long-term, short-term, and current. And basically control includes the setting up of goals or knowing what the goals were and evaluate the performance in relation to those goals. And all these control measures require information relating to the financial measurements of the company as well as the non-financial measurements. This is one area in which managerial accounting differs significantly from financial accounting, because as you know, financial accounting is concerned with the dollar amounts, the numbers, the reals, whereas managerial accounting is concerned both with the monetary numbers as well as non-monetary information. Like we have to know what is the capacity, how many units can be made by a company of its various products, and then what would they cost or what did they cost. So we have to have both financial and non-financial information. And the financial information is used primarily in the goals and performance area, because goals of the company are set up in terms of financials and their evaluation can be done in financial areas, but they also require the non-financial measures. In the long-term control, financial measures are more important. But as we go in shorter terms and current, both financial and non-financial measures are important. Then finally we come to the value chain of the company. Now I am presenting this with respect to a manufacturing company. The principal value chain of a manufacturing company is concerned with the procurement of material and services which they use, the manufacturing, the selling, and the delivering of its products. And as you can see from this chart, the inputs which the company uses is in the form of materials and components which they acquire from outsiders, the services which they acquire from the outsiders, the labor of the workers, and most importantly, information which they need. Similarly, the output of the company is in the forms of the products that it makes and the services which it sells to other customers as a part of the package with the products or directly as services, as well as information. Today's economy is an information-based economy. So input and output of information is an extremely important component of everything. So the management has to be concerned with all that. Now the overall strategy of a company with respect to both planning and control is very often stated in terms of a balanced scorecard. Now, balanced scorecard is one of the developments by the accounting profession. Although it is used by management, but it has been developed by accountants, particularly professors like Kaplan and his colleagues. So this is, together with this activity-based costing, which also they developed, are among the most important contributions of the accounting profession to the management of the companies in the world. Now, as you can see, the balanced scorecard has a center focus on the vision and strategy. They have a concrete vision and then a strategy to achieve that vision in terms of their plans and all that. And then they have to set up their goals and figure out how will they achieve those goals. And the goals have to be in 4 areas: financial, internal business processes, customer, and learning and growth. And each of these perspectives of the balanced scorecard has its critical indicators. They have to list those indicators, some of which are lagging indicators, which means they show what has been done in the past, and some of them are leading indicators, which indicate what is expected to be done or achieved in the future. And they have to indicate what is the current situation, what is the goal to be achieved, the time frame, and what are the steps to be taken by the company to achieve those goals. And this balanced scorecard is being used by more and more companies around the world, both for purposes of planning and control. The most important thing here is that they have to keep a balance among all of them. They cannot go overboard with something. Let me give you a small example. What does a customer want? The customer is one of the and not read. Let us forget it. Okay, the customer needs what? Let us see. Customer needs a variety of products which are of the highest quality, and they are sold at the lowest price, and they are delivered to the customer just when that customer needs them. Now a company can do it, but there is a problem. Can they provide products of the highest quality at the lowest price? They can make products of very high quality, but then they cannot simultaneously do it at the lowest price. So there has to be a balance somewhere. So when the balanced scorecard of a company is developed, everything has to be in balance. They cannot keep on, this learning and growth is for innovations and future development. They cannot keep on spending a lot of money on learning and growth if their business is static. They have no vision of what they will do with all that learning and growth. So they have to keep a balance among all these 4 perspectives. Now, an important thing here is that this balanced scorecard is for the company as a whole. But the vision which has been created in this balanced scorecard and the strategies which the company is going to follow have to be understood and adopted by people in the company at all different levels. So at each level of the company, they have to have their own balanced scorecards, which will have the same components, a vision and strategy at their level, and the 4 perspectives: financial, internal, process, customer, and learning and growth. The important thing here is that the customer will differ at different levels. For the company as a whole, the customer is an outside person who pays for the products of the company. But suppose you are at a responsibility center level and you are creating a balanced scorecard for you. Now, at the responsibility center, which is, suppose there is a factory and there is a selling department, and within the factory there are different processes, who is the customer? The work in process is not being sold to an outsider. So we do not have an external customer at that level. We have an internal customer, that is the next department or next process that will use your product. So you have to identify your customer at your level. And you have to see what you are supposed to do at your level. So you set your goals and an internal process according to what you are supposed to do. Similarly, your financial perspective, you have to measure what you are in charge of, what is under your control. For example, for the company as a whole, the financial measure is the profit and the return on investment and things like that. But at the factory level, they are not concerned with sales or profits. They are concerned only with the cost of goods that they make. So their financial measure is primarily their cost. And therefore, we have to be very clear in our development of a balanced scorecard at our level that it reflects the strategy of the company and it helps the company in achieving their goals, but it states the vision and strategy at our level and all the indicators which are relevant to us. Now, all this kind of information, the accountants are among the primary suppliers of this information. They develop the information and provide it to the management. And it is said that the accountant should provide information which is kind of relevant to the manager's need. Let me tell you a little story which I'm sure most of you have heard. There is this balloonist, the people who fly in the balloons. He is flying in the sky but loses his way. And he lands in a place which is not familiar to him. Now he looks around and sees a gentleman very well dressed and with a green eye shade walking by. And he says, "Sir, can you help me? I have lost my way. Can you please tell me where I am?" And this gentleman looks at him. "Yes, I can tell you exactly where you are. And that is, you are in a cornfield." And this man thinks about it and he says, "But tell me please, where is this cornfield?" And this man says, "Hey, that is very easy. It is right in the center of the 300-acre estate of the company." This man thinks for a minute and then he makes a comment, "Sir, do you happen to be an accountant?" And this man says, "Yes, but how did you guess?" And he says, "The information you have given me is very accurate, very precise, but totally irrelevant and useless for me." We do not want to be that kind of accountant. But since you are in a good mood, let me tell you another story at the other extreme. What the accountants can do. There is this one accountant who is being interviewed for the position of the chief financial officer of the company. And the person who is interviewing him is the chief operating officer, the president of the company. And he goes on through the routine of the interview that finally he has one question. The interviewer asks him, please tell me what is 2 plus 2. And the accountant looks around, goes to the door, closes the door, pulls the drapes over the windows, and comes very close to the interviewer and whispers in his ear, I will make it whatever you want it to be. Now, do you want to be that kind of accountant? No, actually, when I used to work for Price Waterhouse, as you heard in my introduction, I had a boss, and who told me one day that when we are making a report, all we need to do is call a spade a spade. That is, tell it as it is. Don't mix words or misrepresent anything. That's what we need to do. Okay, in order to do all that, what have the management accountants been doing? Now, let me also mention one thing. When these developments of accounting started to take place, what was the situation at that time? In 70s and earlier years and in 80s, the most important thing which was happening was the automation. Everything was being done, more and more things were being done by the use of machines, and later on with the help of computers. And what did it do to the manufacturing and service industry? More and more mechanical means were used, increasing their overhead costs. And less direct workers were needed, reducing their direct labor costs. And that changed the relationship between overheads and direct costs very, very considerably. Another thing which was happening at that time was global competition. Things were moving from one country to another and just being sold. For example, in the 1970s, when I came to America, we used to buy American cars. But then some Japanese manufacturers began sending their cars to America, Toyota particularly. And people were looking, what is this little bitty car? Americans are used to big, huge, big cars, which gas guzzlers, as we call them. And here these little bitty cars, we cannot even fit into them. But slowly they found out that they were cheaper, because that is what their push was, that they are cheaper cars. So they were cheaper, so some people began buying. But when they began using them, they found they were not only cheaper, they also had much higher quality. The American cars at that time, if you have to make a 100-mile trip, you will be lucky if you can make it without a breakdown. And these Toyotas or other Japanese cars, they go 300, 400 miles without being breaking down. I say, this must be something good. So this competition from abroad had given a wake-up call to the managements of the companies. And it happened not only in America, but every other country which was in an advanced stage at that time. And this affects the management. What are they supposed to do? Go out of business? They don't want to go out of business, they have to compete. And in order to compete, they have to manage their business in a better way. And for better management, they have to have better means. And one of the means they used was, of course, management accounting. So they have to have improved management accounting. So one of the techniques which was developed at that time was activity-based costing. Now, what activity-based costing do was that they looked at the various resources which the company uses for their manufacturing and service activities. And these resources were then related to the activities and activity pools. And these activity pools were then used to make their products. So there were numerous products which they were making, the numerous resources they were using, and they had many different activity pools. Now, this kind of combination required both a physical combination of things and correspondingly a financial combination. They had to find what are the costs of various resources that they used, and therefore what are the total amount of the cost of the activities which they are carrying out, and then allocate those activity costs to their various products in an appropriate manner. And in order to allocate those various costs to the products in an appropriate manner, from activities to products, they divided the activities into several levels. The highest level was the product level costs, that is when they are developing a new product or making changes in a product, what costs are being incurred. And these costs are allocated among those different products which they make, regardless of the quantity of a product being made. For example, suppose they spend 10,000 riyals to add a feature to a product which they are making. Then that $10,000 is being spent regardless of how many units of that product they will make. So the product level cost is to be allocated to the product only, at the product level. Then the products are made in batches. So you don't make 10,000 units at one time, you possibly make them in the batches of 50 or 100 or whatever suits you. And there are some very significant costs at the batch level. For example, suppose you make many different things, and one thing is being made, one product is being made, and you have set up your machinery and other equipment to make that product. Then you have to make a batch of a different product. So you have to change the setup of the machinery. You saw this morning when the people were making this artistic performance, the setup was different. Then how many people had to come to change the setup? I counted 8 people were required to just change the setup, to bring this forward, so that, and put the things, the water bottles and all that on the table. So that is a batch level cost. It doesn't matter how many people will sit here. Nobody is sitting here now, and so many people were sitting earlier. But that cost had to be incurred because there was a change in the setup. So those batch level costs are incurred whenever a batch has to be changed. And then the costs which are incurred, they are of course applied to that particular batch. If suppose a batch consists of 50 units of a product, then the cost which has been incurred at the batch level has to be allocated among those 50 for that batch. And that there will be some unit level costs. The cost will be allocated to the units, and we will get the cost per unit. Now the details of these calculations are the heart of activity-based costing. And of course, I'm not going to go through all that. But let me mention one thing more. I mentioned to you that they have to allocate the costs of resources to activity pools, from activity pools to the products through this process, which is at different levels. Now for these, they have to have cost drivers and cost driver rates. The cost drivers are basically the outputs of each level. For example, when we say activity pool, the cost driver will be based upon the output of that activity pool. For example, suppose your activity pool relates to the procurement process. Procurement means you have to buy things from the outsiders. There are many different kinds of resources that are used. You have people, you have your computer, you have paper, and things like that. And you have energy and space and all that stuff. You collect that and figure out how much is the cost of running this department, procurement department. And then when some orders are placed, then you allocate them among the orders. So suppose your cost was 10,000 riyals and you placed 1,000 orders. Then what is the cost per order? You will say $10 per order. But here is where a difference arises. And that difference is very, very significant difference. And that is when you set up that department for procurement, you had some capacity which you knew they can handle. For example, how many orders they can handle with the resources that they have. Can they handle 1,000 orders per month, or they can handle 2,000 orders per month, or just 500 orders per month, and so on. So one question which arises is, how do we calculate the cost driver rates? Should we apply the total cost to the actual output, the actual number of orders which were handled by them during the month, or at their capacity? When activity-based costing was originally developed, they used the actual activity. And as you can imagine, this would change from time to time. The same department is handling orders for procurement, but if they placed more orders in 1 month, the rate will be less because their costs are about the same each month. They are using the same resources. In another month, when they have a larger number of orders, the rate will be smaller. And that gave rise to the question, should they calculate the cost driver rates on the basis of actual numbers of the output or on the basis of their capacity? And the activity-based costing people decided it should be the capacity. And we will talk about that a little bit more, because again and again I will come back to this capacity question in this presentation. Now, what is a capacity? Let us look. There are 3 possible measures of capacity. One is the theoretical capacity, one is practical capacity, and then there is normal capacity. Theoretical capacity is that suppose you have a piece of equipment, then you will use this piece of equipment, how they say, 24/7. That is 24 hours a day, 7 days a week. There will be no stopping, no breakdown, nothing. It is perfect system. That capacity will be the theoretical capacity. But nobody does that, except in very, very rare cases. Then we look at the practical capacity. When you bought that equipment, did you intend or plan to use it 24/7? Or did you have something else in mind? Now we know that normally companies will work 5 days a week, 8 hours a day. So our capacity should be based upon the use of 40 hours per week and probably just 50 weeks a year, not 52 weeks, because 2 weeks nobody works. So it will be that. And then even though company is working 8 hours, they are not exactly devoting time because they have to clean up and set up and things like that. So they may be working only 7 hours a day. So you have to figure out what is the practical capacity on the basis of your plans, which the management had in mind when they acquired that equipment, and your practices. So that is the practical capacity. And then there is another concept which is called normal capacity, which only shows normally how much capacity is used, which could very well be less than the practical capacity. And then when you are making a plan for the future, Then you can say how much is the budgeted capacity for the next year. And then you compare it with the capacity which was actually utilized during that year. And we have to think about that also. Now, the activity-based costing uses the practical capacity to calculate the cost driver rates. This also gives us a measure of the cost of unused capacity. For example, the practical capacity is 1,000 units, but you actually make only 800 units. Then what happens to the cost relating to the 200 units which you did not make? That is called the cost of unused capacity. When you look at some economic numbers, one of the numbers which comes out is what is the capacity utilization by industry today? I was told that in Brazil it is about 85%, which to my mind is very, very high and possibly overstated, because that is a very high number, 85% utilization of the capacity. But even then, what is happening to that 15%? We are incurring 15% of our costs and getting what against that? Nothing. That is a waste. And if you look at individual companies, possibly the cost of unused capacity is quite large. And therefore, in activity-based analysis, a lot of importance is given to the cost of unused capacity. Now, I've been talking a lot about activity-based costing and whether you should use the actual utilization of capacity or practical capacity to calculate your cost driver rates. Now, what difference does it make if we use one measure or different measure, or our ABC system or a different system? Let me show you. I will not go into the details of these calculations, but I'll show you that there is very, very significant difference in the cost of a product if you use different methods of calculating the cost. Our old system was absorption costing using one single rate, which is based upon maybe on direct labor or direct labor cost or something like that. Now, the data which I am not going to show, but if you want, you can email to me, I'll send you the data. There are only two products. If there are more products, it will be more complex. So under this system, the product A costs $45 per unit, and product B costs $91 per unit. Now, if we use different rates for different departments, which is called departmental rates, and when I further divided total overhead cost to those two departments and calculated the rates, the numbers became very different. Product A cost only more than previously, $55, and the product B a whole lot less, $76 only. Now, it is the same product, same process is being carried out. It is a matter of calculation. How do you apply the cost? Then there is another system which is called direct costing or variable costing, in which you apply only what is called a variable cost and ignore the fixed cost. You don't allocate the fixed cost among the products. So fixed costs remain unallocated, which in this example was $70,000. And you can see product A is only $35 and product B only $71. Now, even though both are less than the previous calculation, but the way they are less, their relative values are significantly different from each other. Now let us go to activity-based costing. Standard costing. That is one of the things which accountants are very proud of, that we have these standards and variance analysis and all that. So what does the standards give you? The cost. You can see what will be my cost 10 years from now, If you are using a standard, this will be my cost in 10 years. All that you do not know is what will be my variance. So under this system, the product cost of A and B are as given, 52 and 73, and the variance is 11,000 unfavorable because the company spent more in total than what was budgeted or what was according to their standards. And as you can see, these relative values or costs of the two products are different here again. Now we come to activity-based costing, and this one is using the cost driver rates based upon the actual utilization of the capacity of various resources. And this shows a very, very different numbers. $31 for product A and $112 for product B, which are very different from any other system. But if we use the practical capacity in the calculation of cost driver rates, then of course both of them are less, $27 and $90. And there is a information available to you that you have the unused capacity which cost the company $54,000 plus. And as you can see, this is, I think the total cost, which I don't remember the numbers, but 54,000 is quite a significant number. The extent of the waste is $54,000 out of maybe $200,000 or $300,000. You know what they will do? The chief executive officer, when he sees this number, what will that do? Will jump to the ceiling. Hey, what is happening? What is my company doing? Why are we wasting that much money? And this information in a routine manner is available only if you use activity-based costing, computing cost driver rates on the basis of practical capacity. Under any other system, if the management wants, hey, let us see what is our unused capacity, they can have a special study carried out and guess some numbers and all that. But under ABC, when the chief executive officer receives the monthly report or whenever they get the reports, that number is right there. And that is calling for attention. So that is the kind of information we want to give to the management. Now, I told you that, how much time do I have? How much more time do I have? I don't know. Let us continue then. Okay. Now, there are many non-manufacturing activities carried out by companies, and there are some companies which manufacture no product, they have just service industry. We can use activity-based costing for them also. Now, for a normal company which has a manufacturing, the non-manufacturing activities, some of them are vendor-related. When they buy things from outsiders, they have to, some costs relating to those vendors. That is like negotiating a contract with them, placing the order with them, when the goods arrive, inspecting them, making arrangements for payments and all that. So those costs are related to vendors. And we can analyze them and find out what is the cost relating to each vendor, and then allocate that vendor cost to the products or to the material or components which we buy from them. Similarly, there are some product-related costs which we may call product management costs. For example, research and development or marketing for a product or advertising. Those kinds of costs are not manufacturing costs, but they are related to products, and they are product management costs. And they are quite considerable. Similarly, there are some customer-related costs. Customer-related costs are delivering to the customer, providing service to the customer, and so on. Some of these costs are quite significant. And it has been found that not all customers which buy the equal quantity at the same price will be profitable to the company to an equal extent. For example, if two customers buy 1,000 units each of a particular product, one may be providing a good profit to the company, the other may be leading to a loss. Why? Because this other customer requires a lot of service calls from the company, lot of help, and wants delivery of a few units at a time. So all those costs are being incurred by the company, and which are customer-related costs, and the customer may be unprofitable. So when we analyze these costs on this basis, we can see which customer is more profitable and which is less profitable for us. Then there are other internal support and general administration costs. And all these costs will be used when we are analyzing the profitability of various products or various customers or various business units and so on. Let us look at this product profitability. You remember that in external reporting also, we have to provide segment reports, and segment reports require some information about each segment, and the segments may be on the basis of products or customers or regions and things like that. And in management accounting, we have been doing forever, and with the help of activity-based costing, we can improve that presentation. Now, in product profitability, we take the sales of that product and the cost as computed under ABC for each individual product at various levels, like unit level and batch level and product level. And also, we can calculate this product management cost which we talked about, and that gives us the product profitability. Now, sometimes several products are combined together and we call it a product line. Then there may be some costs relating to that product line rather than individual products. So we can deduct those product line expenses and calculate the profitability of that product line. And there will be some costs which are not allocated to these products or product lines, and they will be shown separately in the total column, and they may include unused capacity cost, facility level costs which are not allocated among products under ABC, then business unit and regional expenses. Similarly, we can do for customers. We can calculate customer profitability same way. We take sales minus ABC cost and customer sustaining expenses. And if we are combining customers in different groups like channels, then we can deduct those expenses relating to those customer groups and find the channel profitability. And the expenses which will not be allocated will include the same kind of stuff. We can also make this analysis for business units or regions and things like that. But the information which we have developed under ABC can be organized in different ways according to the needs of the management. Now, let us look at some of the uses of the activity-based costing and how does it improve the decision-making process, as well as how does it help the strategies which the companies or the management of the companies may adopt. Now, there are several kinds of decisions. If you are accounting students, you know, you all learn them in cost accounting courses, that if there is a special order, should we accept it or not accept it? How do we calculate that? And if you remember, you have always to think, hey, do we have the capacity to make the additional units for the special orders, or we will have to divert the sales from the customer? If we have the capacity, then how much will it cost to make that product? And on that basis, you make the decision whether you should accept the special order at a lower rate or not. Now, if you are using ABC, that information does not require a special investigation. The information can be found from our ABC records much more easily. All you have to do is figure out what is the cost according to our ABC, and then if you have extra capacity to make it, then how much will be the decrease in the unused capacity, and therefore how much will be the decrease in the cost of unused capacity by by taking this special order. So your net cost will be the ABC cost minus the decrease in the cost of unused capacity. If you do not have unused capacity, then the ABC cost is the total cost that you will have to incur. And compare that cost with the revenue you will get from the special orders. So that kind of stuff is more easily available and more accurate under activity-based costing than under other systems which require a spatial investigation to be carried out and the figures to be estimated. Similarly, outsourcing or make or buy decision. Here you are comparing the savings which you will have if you outsource something. For example, you ask some people maybe in India to take your telephone calls rather than in Brazil. Then you are saving the cost which you would incur in Brazil, but you are incurring the cost which you will pay to the people you are outsourcing to. So what do you compare? And the question is, one important thing which is very related to this capacity again. If you are outsourcing some service or some production component or something like that, and if you are making it here before, then you are releasing some capacity which is becoming unused now. Now the question is, do you have any plans for using that capacity which has become available to you after you outsource something? And you have to consider that as to what will be the net income from the using of that capacity which has become available to you. Unless you take that into consideration, you cannot make a good decision. Similarly, you have this dropping of a product or a segment, same kind of stuff. If you are incurring a loss on a product, if you drop it, you have all those calculations we have learned. Similar calculations will be made under ABC, but the information is available more readily and more accurately. So those kinds of decisions are made, and they may be different because the information which you develop under ABC may show some kind of different numbers than what your spatial investigation would have shown, and takes much less time, of course. Now, in planning and control, the planning is in terms of budgets, which could be operating budgets for year to year, and the ABC costs and the capacities which are available for making different products. That information is very helpful in making a budget, operating budget for the future. Under normal circumstances, you want to increase the sales of a particular product, and you have only to guess whether we can make those additional units or not, or at what cost can we make. If you have ABC system, that information is much more easily available because you have all this cost of unused capacity and the non-financial information about what is the unused capacity in which resources. And then you can put two and two together and see, okay, we can make these products, more products or less products, and what will happen. So that information about capacity and capacity cost and the cost under ABC are very useful in making operating budgets. Similarly, when you make capital budgets, you have to justify the need for capital investments. And again, if you are using activity-based analysis, it helps. The expected cash flows based upon ABC information, which will probably be more accurate than you are just making estimates. And variance analysis is a very important part of our control system. And as I told you earlier, then this is one of the things the accountants have been very proud of when they developed the standard costs. And then they also had this variance analysis, and they divided them between rate and efficiency variance or rate or volume variance. Now, if you are using ABC, you can also have an unused capacity variance. So it gives you a lot of information. Now, I'm told that I have only 5 minutes left. So let me go to some strategies. I'll just try to go I don't devote that much time. One strategy is a continuous improvement strategy. And continuous improvement has been approached in different manners. The way I approach it is divide the activities into these 4 categories: value adding, non-value adding on one side, and essential and non-essential on the other side. So there are 4 categories, and as you can see, our activities which fall in the column A, they are the core activities of the company which they should enhance and keep on increasing, but also figure out which of those activities by technical improvements can be eliminated, so they become non-essential. On the other hand, there are a lot of activities which are non-value adding but are essential. And I'm sure there are lots of administrators here. They know most of their time is devoted to controlling their non-value adding but essential activities. And every company has that. And they have to try to minimize those activities. And once they can find some to be eliminated, they go into the last column D, which are activities which have been identified as both non-essential and non-value adding. We should try to eliminate them. Now, I will just take this one more topic and then possibly we'll have some concluding remark. Now, one of the things which I mentioned earlier and which has become a very important thing in management, that is theory of constraints. And what theory of constraints is that the company has different resources and they do not have the same capacity. They have different capacities. Suppose there are so many resources, and how much can the company make? That will be equal to what the resource with the smallest capacity can produce. And the theory of constraint tells us don't make more than that in the earlier stages. And we should flow this and utilize that particular resource to the fullest extent and try to expand that if possible. Now, activity-based costing kind of complements this analysis. As you can see, this green and blue area, that is what is emphasized by the theory of constraints. What ABC is supplementing it is with the analysis of this red area of the bars. What is that red area of the bars? That is the cost of unused capacity. And also indicates what is the available capacity. If you increase the capacity of the one resource which is in short supply, then what will happen? The green area will expand, but we may still have these red areas in some other sources. So ABC and TOC can be combined and they can work together and provide some financial numbers and so on. Now, since my time is over, I'll just go to... I like to make this one little joke, and then I'll stop. You have heard the joke, why did the chicken cross the road? I did not tell it to the translator, so I don't know whether he'll get it or not in the same fashion. But it is a universal joke. Why did the chicken cross the road? My question is, why is financial accounting moving towards managerial accounting? And the answer is because managerial accounting, as it is being developed now, is much more useful to the management and to the companies than financial accounting is. So they are becoming closer. And I just tell you, why are they become closer? How are they become closer? In olden times, cost of unused capacity was ignored in financial accounting. They didn't bother about it. But now, with international accounting standards, which are being translated into American standards also, I don't know in Brazil they are doing the same thing or not, they are reporting cost of unused capacity as an expense separately in their income statement. That is bringing financial accounting closer to management accounting. But they are not calculating it in identical manner. They are using normal capacity as a practical capacity, for example, and relating this only to fixed cost, whatever that may mean, and not to variable cost, whatever that may mean. So it is still different, but it is in the right direction. And similarly in segment reporting, my gosh, it seems to me that they are just giving up. Financial accounting is just giving up. You know what do they want in segment reports now? They say, define the segments as it is defined for internal purposes. And give the information which the chief executive officer gets for those segments. And if a company is using activity-based analysis, if it is a well-managed company, what kind of information are they getting? Activity-based information. So the segment reports have to be prepared using the activity-based information and reconciling it with whatever financial accountant thinks is the information which should be reported. So they are coming closer and closer. And I think I'll close this presentation and I'm open for questions and comments. Come on.
Surendra, we are managing a gift for you. Wait a minute here, please.
Yeah, sure.